Hey everyone, so welcome to CyberBulls, another great show. So we have on tap with us, as always, we have Alexandra. She is what I call the power bull because she's the most powerful of all of us. She's always making these advocating for good things for Tesla. Christian's our momentum bull. Xander will be joining later. He's our YOLO bull. And me, I still call myself the forever bull. So today we are going to be talking about some answers from questions of folks who've been asking. They've been underwater. They've been investing in Tesla in the last year and they feel like they're lost. We've seen the stock go down. We want to give them some advice, want to hear what people think on how to handle that. And then there are some conversations now, and it's always been the bears, and they have some opinions of what is they think is going to happen in December and what's going to happen in 2023. So I'd love to get the opinions of these guys, what they think about these bear arguments. And then we'll take a lot of people's questions if you can submit them up there. So let's start with let's start with this, guys. This is oops, here we go.
No problem.
Oh, you know what? I haven't even done this yet. So while I'm setting this up, Christian, why don't you talk about, as we do, what's happening with the economy? And we've been hearing some people think that's actually improving, but others are now concerned that there might actually be an increase rather than staying steady. What's your thoughts?
Yeah, so just in general, what I would say is, and I wrote this down, we're like in a can't win market, right? We are like in no man's land, right? Good news is bad news because if jobs are good or the economy's strong, then everyone says, well, the Fed's got to stay in play and they got to go longer and they got to go higher for longer or steadier. So good news is bad news. But then we've been talking about recession for like forever, and it's not coming. This is like the longest recession wait for in the history of man. So if we get bad news, then the bears will say, aha, look at the bad news. Jobs are losing. GDP is going down. Recession. So we can't win. Bad news is bad news and good news is bad news. So we're in this very, very delicate situation where the market is kind of rebounded. Now we're kind of giving some back. But in general, we're just kind of just stuck, right? We're essentially being held hostage by the Fed. We see oil coming down 74 today. 10-year coming down 353. These would normally be good things for growth stocks and stocks in general, but the market's down again today after a down day yesterday, especially our stock that we cover, Tesla. So I'll just wrap it up real quick. The signs of inflation are all there for it to roll over, right? We get a CPI next week before the Fed meeting. We get a PPI too. That'll be another little clue to see, do we get a confirmation of information that the Fed could use to slow down the rhetoric? So next week will be a big week, and then right now, again, we're just in a holding pattern, right? So that's kind of just a quick synopsis.
What is your thinking of what will happen with the Fed? So are you still thinking a 0.5 increase, or is it going to be 0.75?
Yeah. I think they'll do 50. I think that's what's in the market. I don't think they're going to deviate from it. I think they'll do 50, and then it'll be back to what does Powell say? Does he come off hawkish? Does he keep pushing it? Does he act a little dovish? Does he, maybe rate cuts, maybe a 25 he'll signal for the next one? Maybe it's a wait, a pause. The market's really not expecting that, so that could cause a December rally. So I'm thinking 50, and to be honest, I have no clue what Jay Powell will say. I'll just be honest.
Yeah. I mean, I want to just zoom out a little bit from the day-to-day trading. We're coming out of a 10, 12-year period of very low interest rates, if not even in Europe, negative interest rates, but the cheapest money ever, right? And there were reasons for that after the financial crisis of 2008. There were less reasons for it between 2016 and 2020, yet the Fed continued doing it. And during the COVID, they just insisted for a long, long time, quantitative easing, lots of money, lots of venture capitalists that got bought at prices never heard of, never seen of. And now suddenly this happens. So we're seeing tightening. We're seeing tightening from the Fed. We're seeing obviously interest rates now 4, 5, maybe even 6%. But this is actually normal. This was the normal. I mean, I'm old enough. I think I'm older than all of you together. No, I'm not.
No, you're not.
but I'm old enough to remember the period where these were actually low interest rates, right? Where we come from a much higher level, and 4, 5% everybody would have taken easily. So I do understand the belly aches because it's never funny to move from a moment of easy, cheap money to a moment where it's more realistic. But we're also coming out of a pandemic. This has been the first pandemic in 100 and whatever years, and so the the whole supply chain issue, the whole international trade issue, because I don't know whether everybody realizes the trade war that's going on between the United States and China. At the moment, I read an article for January to March, there are 40% less container ships booked going out from China to the United States. People have completely diversified. It wasn't really only politics. I mean, politics as well, but the Biden administration was much quieter about this than Trump would have ever been. But nevertheless, I mean, we see it with Apple, but lots of other companies have, after the whole Wuhan story, said, okay, this is it for China. The COVID zero policy is not where I want to go anymore, started diversifying into Vietnam and lots of other countries. And so that also moved the container ship market. Lots of people didn't keep an eye on it because it was so expensive and everything was just supply chain. But now everything has come back more or less to normal. And suddenly there are 40% less container ships booked going from China to the United States. What does that mean? That means the trade deficit with the United States will get closer to equilibrium. We're still not there, but we're getting closer to it. So we're actually coming out of a 10, 12-year-old situation that was not normal, right? We got used to it. We got spoiled by it, no doubt about it, but it was not normal. We come out of a 2.5-year-old pandemic situation that was not normal, but that's sort of, moving into the right direction now. And we're coming into a trade situation that was actually desired, but we're getting there much quicker than we were. So I think in a very short, medium term, I mean, I'm not talking the next couple of weeks, but I'm talking short months, we will be in a much better place. The dollar has to adjust because the current dollar level is still putting a lot of stress on Europe, on Asia, on any other economy who just they're pulled into this whole dollar situation and they don't like it. So they need to increase their rates. They don't want to increase their rates. So there are lots of power things happening at the same time, but I have the feeling it's just going to smoothen out. Will we come back to cheap money? No, we will not. But we may probably go down to 3%, or maybe even if everything goes well to 2%. Goes well is actually not the right word, because if we go down to 2%, it is because we have a labor market recession, right? At the moment, we don't see this labor market recession. We had 263,000 payrolls on Friday where they expected 200,000, right? So we don't see the effect yet. And I can actually see it in my little day job. People still have problems hiring people. So long story short, I actually think we will have a soft landing. I don't think this will be a bad recession. And if we have a soft landing, rates will not come down to 2%. They'll probably be around 3%. So yes, mortgage rates will become a little bit cheaper than they are now. International trade will settle down to a much more comfortable level for the United States than it was. The US dollar is very strong and will remain maybe not as strong, but a strong currency. And I do believe in 3 to 6 months, we're in a much happier place. So that is my little bit zoomed out version of it.
Yeah, I'm so happy you said that because I'm so confused personally, because I'm a very optimistic person. And I think I'm a realist sometimes too, but I lean towards the optimism, right? So we had runaway inflation. The world was going to end. There was a war that was happening. This was the biggest thing that we needed to manage. Otherwise, the economy could collapse like it almost did in 2008 and 18. But interest rates were raised. The inflation is now seems to be managed month by month by month. We're hearing good metrics coming back. And so now people are thinking that the inflation has been managed. So it should look like things are going to turn around, that the Fed is going to, they're kind of giving dovish statements now that they're going to at least not raise anymore. They're going to actually slow step down. But instead of us getting happy and being, starting to look forward to a wonderful 2023, there are now people going, oh, this is going to be a massive recession. People are warning about a recession. So Jeff Bezos, Elon Musk, and others are saying that it's going to be huge recession next year. And so I don't know what to think because, I mean, isn't it easier to manage the recession? Isn't that something that's a little bit easier to handle? Like if they just decide to stop interest rates and not increase it anymore, isn't that going to allow us to have the soft landing that everybody says? Or why are we still all very, very, gloomy about what 2023 is going to look like?
Oh, I mean, first of all, I think it's also psychological. If you hammer on people long enough, and I mean, it's been, I don't remember a really happy stock day. I mean, I know we sometimes have 5% up and then we have 6% down the next day, right? But one of those euphoria moments where you just look every morning and you're happy, that just didn't happen for a long time. So if you if you hammer on people long enough, they lose all hope. Is it justified to lose all hope? No, actually, it's when you're the lowest that you should have most hope, but it is just human that when you have had pain, that you are first going through all these other stages of denial, and you have to build up your whole hypothesis again, why you're invested, how long you want to hold, and all that. I understand how complicated that is, how complicated sorry, I have a delivery. How complicated the whole, and you see the delivery man comes and my camera goes off. Can you imagine that? As if it is linked. What? There, it's back. But I understand how complicated it is, but it would be the worst moment to divest now. When you feel the pain in the bones, it's an old saying we had in Germany in the financial markets. When you feel the pain in the bones, that's where you have to relax. And I think people just feel it in the bones at the moment.
And I'll just give a quick shot at it. So also, I think where the market is concerned is, again, straight on the Federal Reserve. Because in one of Powell's press conferences, he stated, I rather get inflation down and I'll take almost a small recession, meaning I could always cut if I have to. Right. So I think the market is just really nervous now that Powell and the Fed is going to overstate it. They're going to raise too much, or the lag effects aren't known, and you're going to get a housing collapse. I don't believe that, but the market's trying to figure it out, and they're selling first and asking questions later. So I think right now the market is pricing in a Fed error. And last week and the week before, we were saying soft landing looks a little bit better with the inflation data. So I'll go back to my opening remarks. Good news is bad news, and bad news is bad news. And when you're in a market like that, you got big problems. You can't get any momentum. And if you get some momentum, they just trade off. They just sell off the rallies, right? And you're just stuck in this.
Can you address this? Because we did see this earlier. The 210 yield curve is inverted, so it's greater than ever since 1981. This is obviously not looking good. Explain to me what's going on and how to think about this.
So real quick, when that yield curve is inverted, now it's been inverted for a while. The longer it's inverted, the more likely that there will be a recession. Now, it's not guaranteed, but odds are, that's predicting recession. I won't go into the specifics why, but yes, that's not a good sign. But, at the same time, we've already had a lot of pain in the markets. And you never know what they're going to do, right? They might, if we don't get a recession and we do get the soft landing, maybe it's a 1 out of 4 chance now. Maybe it's a 25%, maybe it's a 33%. You could see a change in market sentiment. So I really do think it just all depends on the Fed, right? If the Fed cuts, or not cuts, even if the Fed pauses and waits and sees what happened, I think the economy, what Alexandra was saying, that payrolls are good enough, that people have jobs, that the consumer will still spend. But we are seeing more layoffs now. And first it was tech. Now we're seeing it kind of, roll out to a little bit. I think I heard some just random, what was it? PepsiCo kind of taking some steps now, so again, you see some of these other companies that are not tech related that have taken the brunt, start laying off, maybe UPS, something like that. And then you got a bigger problem. So, yeah.
I mean, PepsiCo obviously needs money to buy the semi trucks right now.
but is it wrong for me?
Go ahead.
Isn't it wrong for me to think that that's actually good news? Because if you start seeing signs of recession, people laying people off, seeing the 210 inverted, that's good news, because now the Fed's going to go, okay, we got signs of recession. Let's flip.
I want to insist on something I said last time, and you both didn't agree with me. At least Christian didn't agree with me, which was like, we don't see the effects of the Fed yet on housing. Housing is still much too high. Housing rose much too quick during the COVID, and currently unaffordability is enormous, meaning that the number of people who cannot attain purchasing a home, right? And that's a measure that actually the Fed should take into account. I think they take into account lots of stuff I'm doubtful about. But the one thing they should make sure is that money supply and the way the whole economy works, the part that they can influence, allows people to buy homes, because that is still the thing that makes people, grounded and construct, exactly, because from that derives a lot of things. It derives your desire to work, to have a family, to whatever. And currently we're not there. And I do believe they see how lagging the response from housing is. I think we have a couple of problems in the housing market. Buyers just buy the high interest rates, just completely backed off. So there are no buyers there. And the sellers just don't want to lower it enough because thinking, well, there are no buyers around. Why should I start lowering, right? So we have these very lagging adjustments in nearly all markets. I'm surveying 3-4 markets that are not biggest is obviously one I want to purchase, but a couple others because just I find them interesting, including Austin. And as long as housing doesn't react, they will keep poking.
Going,
they will keep talking on, saying the housing market and mortgage rates have to adjust so that housing becomes affordable again. And we're just not there. People don't want to react on the housing market side.
And then, is it true? I heard this.
Well, Herbert, real fast for what you said. The reason so what Alexandra said, I still disagree a little bit. I don't think we're going to get a massive housing correction, but I love what you said, and you could be absolutely right. We haven't been building homes for a lot in the last 5-6 years. So again, people are less likely to move, meaning more people will stay. So as long as you have that marginal buyer that has a job and 2 incomes coming in, I think it could withstand. Maybe we go down 10%, maybe we go down 15%, but I don't see that 30, 40, 50% in house values. But to your point, Herbert, you said, isn't that good? No, here's why. The market is not pricing in a full-blown recession, meaning if the Fed goes too hard and we actually get a 2 GDP contraction, which we did, but they said, oh, it was an inventory recession, or the labor market was still strong. And then the last 2 quarters were growing again. So it was like a technical recession, but not really. If we actually have a real recession where unemployment goes up 2% and people don't have jobs and the consumer slows down because interest rates are high, and then businesses don't make the earnings that they need, and the earnings go from 220 next year to say 200 or lower, then you can get that next 20 to 25% down in the S&P, and we've already got 20, and that's where you go from, say, a 20% mild recession, maybe no recession, to full-blown recession. We're going down 35, 40, 45% in the indexes. So Be careful with that.
And then I did see a statistic that said that even when Feds pivot in previous scenarios, it does take 3 months or longer for you to actually see the stock market react. So,
well, I mean, you have 2 phenomena. When people anticipate the Fed pivots, it actually starts much earlier. And then once it pivots, the news is there, but it doesn't move anymore. And then it takes a couple more months to really see it in economic data, and then the market follows again. So I saw that MEM statistic, and I was thinking to myself, well, that's a bit short-sighted because they don't take into account what happens in anticipation. The market is always anticipating these things much earlier. But I also want to come back to something where you will actually have to help me. I wasn't here in the United States in 2008, right? I mean, I heard about it. I was obviously very interested in the topic, but I didn't live it. I was not shocked like most of you were. And I think that gives me quite a different perspective of things. When I talk today to Americans about recession, I feel what I called earlier, this fear in the bones, still very alive. I think lots of people have really had the trauma of their lifetimes. I will say the financial trauma of their lifetimes in 2008. Us Europeans, we didn't, because the European socialism, how I call it, and any Europeans here, please stop laughing. The European socialism, how I call it, balances everything out, right? Nothing ever has the big upswings, but also the downswings are just, smoothened out because of the social structure of it. Do I like it? No, that's why I left Europe. But there's clearly the benefit to it that the bad times are also, pointed out. For example, France for the last, I think, 6 months has been paying subsidies to gas stations, right? You get your petrol at a much cheaper price because the state pays part of your petrol. I mean, try that in America. It's the other way around. They tax it. So the whole 2008 trauma, this huge recession, this really, grand financial crisis, you all have it in the bones. And I always have this feeling that you say to people recession now, they're like, oh my God, how bad is it going to get? Right? Yeah. Most recessions are soft. And when I say to people, well, this is going to be a soft recession, because it is, the consumer is still spending, they're still traveling. I published pictures from Vegas. They're just throwing money out of it. Yes, they're starting to max out on their credit cards. I'm not saying it, but this is the behavior of a soft recession. There have been many soft recessions. When I learned financial analysis, That was 7-year cycles. I mean, I know they changed a little bit because just technology brought lots of shifts with it, but it was, you had a height, and a couple of years later you had a low, and you had a height, and most of them were soft recessions where your growth rate was maybe 0, maybe 0.5% less, or maybe just 0.5% up. But you can live through soft recessions. And if you have the right business model, to bring us back to Tesla, you actually thrive, because these soft recessions bring your competitors much lower and bring you much higher. And it is a period where empirical studies have shown, if the market leader, or the one that disrupts in those moments, invests in ad, invests in education, takes a lead like many others, because the ones that are in bad financial health in a soft recession have to cut back. For them, there is not enough fat left in the market to feed them up, so they have to cut back in ad spending, they have to cut back in lots of other things, and the market leader can really take the run and bring it home, right? So please de-traumatize from your 2008 trauma. I give it to you, you've had it, no doubt about it, but I think it's over. This one is nothing comparable. The houses that are out there were bought by people who had on average a credit score between 680 and 720. These people still have jobs. These people can still sell their houses. The houses are too high. The last 2 years have been exponential. If they come back 30%, they're still not at 2019 prices, right? There is a lot to give back in the market by people who are liquid. We will not go into a hard recession. There is no doubt in me.
I do have to kind of point out, though, that our audience are Tesla investors. And so Tesla investors had an amazingly bad year. 2022 has been traumatic to us. 50%, 60% reduction in price from the all-time high from the beginning of last year. So many of us have seen our net worth fall. And so even what I'm doing is I'm actually freeing up cash, not because I need to, but because I'm preparing for 2023. And normally, and I'm going to be buying more stock. Part of the reason I'm doing that is I'm going to buy now, but I'm also trying to be careful, learning from Christian. I'm learning. I'm going to have some just in case 2023 is a bad year, but I'm optimistic. I actually start feeling like, okay, this is a time to buy stock, not all of my money because anything can happen, but I think, like you said, I think it's going to be a soft recession because in my mind, the recession's easier to maneuver the dial versus a runaway inflation. They don't know what to do with that. I may be wrong, but that's my opinion. So let's switch to the next topic, which is, we've gotten a lot of responses from people. Two kinds. One is people are saying, listen, I'm not like you guys, okay? Not necessarily us three, but just some people. Like I just interviewed Jason DeBolt, and people are saying, I'm not like him. He bought early. He made his money. We started buying in 2022, beginning of this year. We are underwater by 50% at this point. Please help me figure out what to do and think about this. So let me kind of share this, kind of this tweet here. It says, I started buying Tesla since December 21. I've been buying the dip ever since. My average is 350. So times 3, we're talking over 1,000. For 1,350 shares, I'm currently down 190,000 shares. Okay. Then, and in that same thread, it said I started in September 21. Otherwise similar. I'm at 292 for 430 shares. And then somebody says, congrats. You will look back at this position quite fondly and with a smile in a few years' time, Tesla 2030. And then somebody says, well, interest rates party is over, which you just said, will be for a few years. Competition stealing Tesla's lunch, and the CEO is becoming more and more. I think I cut it off, but I think we all know what he's about to say. So before I get to this slide here, let's pause for a second, which is, the bear arguments, and we'll debate that. But what is your message, guys, to people who really just bought this year and they're feeling just terrible right now? And what would you say?
I'll just go real. So we've talked about this before. I am sympathetic to anyone who's, jumped in, and maybe they've jumped in heavy because they were running and they didn't want to miss it. And we were off to the races, and, you got kind of caught up with it, and maybe options or margin. I get all that. So I am sympathetic with that. I guess what I would say is, whatever did occur, use that as a life lesson and your investing journey. Use this. Don't just sit with your head down and for the next year beat yourself up. What's the past is the past. It's over. It's done. You can't do anything about it. You can only move forward. So you can learn the lesson and try not to repeat it. And then now use your judgment and say, okay, where am I? Where do I want to be going 5 years out, 10 years out, 15 years out? And, it's not easy, but this is just general advice. Put yourself in a position where you could be successful. So if you've done your homework and maybe you're down on Tesla position, but hopefully you don't need to liquidate that position at a loss and you're able to hold it. So allow time to be your friend. And hopefully that's the case. If it's not the case and it's something where you need the money right away, you have to do what you have to do. There's no great answers, right? Life is life. But what I would say is, when you go into investing's not a get rich quick scheme, even though it seemed like it in 2020 with AMC and GameStop, and we had liquidity all over, and the Fed went to zero, and the government was pumping out stimmy checks. That's not a normal time period. That was excess, and every once in a while you'll get a period like that. But we had that kind of in 2000 with the tech bubble. But now I think, that's probably not going to happen for a while. So we're back to a normal market where maybe, you get an 8% S&P, you're happy, right? Or a 7% S&P with some dividend and, you had a nice year. And so I think we need to get back to realistic returns for just equities in general, where we're not looking to, 5x our money in a year or two. I think those days are over, unless some type of dramatic breakthrough does happen. Say Tesla does solve something that or the market's not anticipating, you could have it. But for 99.9% of the stocks out there, most people understand the business model. You're not going to get these huge moves anymore unless, you get something out of the woodwork. So I would just say, use it as a lesson. Try not to compound the mistake. This is one other quick thing. Some people get down on their position and they want to make it all back real quick, and they'll take even a bigger gamble to try to make back what they lost, and then that doesn't work out, and then they're done. So you don't do that. Be very careful what you're doing. Capital is extremely important right now. Liquidity is extremely important like now. Like Herbert said, you never know. Maybe there's a bigger drop to happen, but at the same time, you don't know that, so you have to dollar cost average in. So that was great advice. So all I would say is, learn from your mistakes and keep your head up. And, I think tomorrow will be better and a year will be better from that.
And maybe I can share, and I'm sorry for my voice and for the coughing earlier. Maybe I can share what I do. I'm obviously trained as financial analyst, but I also want to make sure I have my budgets in order, very German organized. So I have monthly income, right? And I have my monthly costs for keeping family running and whatever. So I do my budgets like anybody does in a household, but I also include my financial investment money. I know how much I want to put into my 401ks. I know what I want to do with my IRAs. And so I lay out money coming in and money going out for living expenses and for investments. And when I do my strategies, I have my factor of what is not going to be touched is a stock, and for which I have a certain horizon, 2030, 2035. And that stock I don't worry about. There with a certain bank in certain types of accounts, I don't even look at them. I mean, I have a spreadsheet and I know what they would be valued at, but I don't look at that on a daily basis. And then I have the shorter term investments, and they can be options, they can be margin, they can be whatever, however my market sentiment is. But I always ask myself if the stock and the options and whatever is on margin goes to zero, because when I'm in margin, I'm risking everything that's in that part, right? Again, this is not the part that's in my retirement account. This is not my part that's really in the savings. This is my part that I would call trading. And that trading part, I dissociate myself with. I'm telling myself, can I stomach if this would go to zero? And if I cannot, well, then part of that moves into the savings part where I preserve it, right? So if people start understanding that it could all be in Tesla, right? If this is the stock you've analyzed and you appreciate, and there is no second or third stock that also comes close and you want to consider, well, then you're all in that. But then do understand that part of that has a long vision, part of that maybe has a medium-term vision, and that depends on your personal goals, your age, how long you want to hold. and those parts and just tuck them away. What the heck, it's 180 or what the heck, it's 5,000. It doesn't matter because your goal was 2030. And then your trading portion, if from the beginning you understand this can go to zero, it doesn't hurt you. You're actually opportunistic. You have a different attitude to that. And that's the one I look at. That's the one that some days will be 50,000 or one day will be 500,000, right? That's the part with which I'm prepared to take a risk because I can lose it, because I know my future income stream. I know that I can stomach everything else. And this was the leftover I want to gamble with. And let's just call it. It's gambling. It is. Mm-hmm. It's gambling on the company I love and cherish and do all the research for, but it's gambling nevertheless because there's so many other actors here that can spoil my fun, and I'm prepared to take that.
I think I'm just going to say something that I think we all already understand, but I think it's worthwhile saying it so people just repeat it in their heads, right? Which is when you see your stock price go from high to low, you've not lost any money. It hasn't been a loss yet until you decide to sell, and then you truly have a loss. And if it's a company that is dying or falling, like if I had this in Meta, I'd be very, very afraid. I'd be very, very afraid because I'm not so sure. I'm not so confident of what Meta's future is going to look like. It could rebound, but it could also just continue to fall because its business fundamentals of a company and its competition, what it's trying to do is in question now. But I have to remind myself, this is in Tesla, and we know that Tesla is going to continue growing. We feel very strongly with everything we've learned and what we think is going to happen, that it's going to be not only survive as a company, but actually thrive and continue to grow. So for me, I don't lose any sleep watching my stock fall from Tesla because I look at Tesla as a company, it feels strong. So I think all of us know that, but there are some and many that kind of show this one, that are in dire situation right now. So this person here says, I bought in margin. Do you think I'm going to be safe with margin right now? Because what's going to be the low? Should they ride it out the storm or should they take the loss? And they bought heavy on margin at $250 share price.
If he bought heavy on margin, obviously he had margin calls before, right? At 250, you probably were called down to, once you went below 200. So these people have already paid part of their dues. When you're on margin, you have to reevaluate the whole situation every single day because your bank reevaluates it on every single day. Yep. People often don't understand when they go on margin, they actually give their investment portfolio that's underlying to the bank or to the broker that gives them margin. The broker or whoever, the bank who does it, lends you usually 50% more, so you can use those to purchase more stock, but they have the hand now on your existing stock. And if the price moves down, well, they are not risking anything because they have the hand on your shares and will take them away of you. So you have to be every morning before the market starts evaluating the situation as a new. Don't start by thinking, oh my gosh, I bought it 256 months ago. That's gone. That's gone and has been readjusted 180 times since. Not Saturdays, Sundays, but every other day in between. You're going into the situation today. The stock is today, I don't know how much it is. I didn't check today, 182, 184. I don't know where it is. Is that a situation you still want to hold them on margin or you don't? You can get out of margin tomorrow. You can sell the shares that are above the cash you put into it, the stock you put into it. So don't have a long-term view. Margin is gambling. And you have to, people cannot just say, I'm investing with margin. No, with margin, you're gambling. With options, you're gambling on time. It's not bad to gamble. But don't fool yourself. That's not investing. It's just
the best strategy though is to put in more cash to reduce the margin.
Well, you could do that.
Hold on.
Most people don't have a lot of cash to put in.
No, I know, but you should find as much as you can because the stock is temporarily low, and you need to just cash in so that you don't get forced to sell. That's why it's a loss. That's
but Herbert, I hear what you're saying, but
I know.
Most people, the reason they're on margin is because they don't have cash. Because you're using margin as cash because they're like, I need more money. I got to buy the dip.
Exactly.
So if they had all this cash laying around, why would you use the margin? The other thing, I just wanted to explain that. And then the tangent is when you were talking about Meta, I had a vision go off in my head, CNBC, like someone like one of the people, and they would say Meta is the safest stock in the world, trading at a
Really?
9 PE, 10 PE, and they would say Tesla is the risky one, and you're
Okay.
like, I'm scared to death of Meta, and
Yeah.
I with Tesla, I just had to
Me
say
too.
that. It was funny because I had this vision. I'm like, this is like
That
reverse
is
Bizarro world.
You're right.
that is
You're
interesting.
right. You're right.
That is
Now, if your
interesting.
question is,
Yeah.
Herbert, if your question is, would I buy today Tesla on margin? I would not. Right? I have no problem with my medium-term portfolio. I have no problem with my long portfolio. With my trading portfolio, I'm completely de-risked. I love taking risk with that part because it is the part of my portfolio with which I want to take risks and I want to have an opinion. I'm currently neither in margin, nor do I like the few options I still have. I mean, I'm always joking about my January 300 calls. Kiss them goodbye. We will not be at anything close to 300 by, I think it's the 20th of January they expire, but that's just it, right? I bought them too high 3-4 months ago, thought this was a great thing. 300 was, it was just after the split. 300 was just normal, right? Being at old price 900. Well, I lost that one. But again, please, everybody, when you do options, when you do margin, you're taking a gamble. Don't think you're investing. It's the best advice I can give you. And there's nothing bad about it. We're all allowed to gamble. If you want to do that, that's fine. Just do know it could be zero. Do you want to take that risk? Hesitate one last second and then do it.
Yeah.
So,
And just for what it's worth, I don't use margin. Most of my accounts don't allow margin. But even when I have some broke. I got in the habit of saying I'm never going to use margin, so it's just not in my DNA to use it for what it's worth.
okay. And on my side, I did use margin, but only because I have cash. But I preferred to use the margin because the margin is actually lower percentage rate. But I have cash in case I need to cover it. And I do want to say that Xander's not here, but he will say that option trading is also, I don't know if he'll call it a gamble, but he will say that it is very risky. And just to be very clear, while he's an option trader, he also is a long-term holder, and he only allocates, he says, less than 10% as a gamble or to play money with. And so people think, oh, he's an option trader, he's trading everything with option. No, that's not the case. He's actually just a small piece of his pie that he does in that scenario.
Exactly.
But I just want to state one more thing. Again, I'm not an expert in margin, so I don't use it, but I've read on it and I know enough. So I guess you can be responsible with margin, but margin is very dangerous. I don't care about the interest rate. It doesn't matter. If you buy something and that thing goes down 60, 70%, you are going to get called at the worst possible time. And not only are they going to call all your shares, you got to pay. It is a disaster. You could literally take an account worth 100,000, and that could go to nothing like that. If you're in one stock and that stock goes down, not only are they going to call everything away, you got to pay back the loan. You're down. You're out. You're down and out. You will blow up your account. I cannot stress this enough. So we're talking about it very cavalierly. Margin, I guess if you handle it right, but margin, the whole thing of margin is, oh, I want to push it a little more. Oh, what's 5% turns into 10%? Oh, I can borrow up to 50%. It can get carried out away, and out of nowhere, you can get something like some black swan event, and that can go really quick. I think we needed to state that.
Yeah.
Yes, I agree.
Okay, well, this might not be the good question to ask right now, TJ, but does Christian feel it's safe to say Tesla will be worth at least $1,000 by 2025?
So going into this year, we were speaking what end prices are, which is always a tricky game. I was being conservative side, and I said, I guess it would be a split, like around 300 to 330 was my right. So of course, we're not there. Now we have a little bit to go. Maybe we get back over 200, maybe we don't. So I was playing on the conservative side and being on that low. So, which is good. So I had my at least, some people were saying 4, 5, 600, all this stuff. And I'm like, I don't think that's going to happen in that environment. So what I would say is 1,000 by 2025. Of course, it's possible. But what I would say is it's probably dependent on Tesla solving either FSD coming or, robotaxi, bot. I don't know that you're going to get from a 5X just on electric vehicle production. I could be wrong. I just don't see that. The energy, something that the market is not aware of, I believe has to occur. That's just my opinion.
I'm a little bit the same. It's really funny because I think you all know how much I love my Excel spreadsheets and how I do all these funds and stuff. I've never built a revenue model for Tesla. Tesla is the only stock where I just feel fundamentally everything is there, yet every day something can change, right? The CEO could buy a social media or suddenly decide we have a PR department or whatever, right? Every day the whole scenery can shift. My fundamental decision in 2022, in March 2022, when we did that test drive, again, we had for 6 years electric cars. So it was not as if we were, just sitting in the first electric car and having the talk for the first time or whatever. It was like daylight here. This is it. It's probably like you. I was never an Apple girl. But once you had the Apple phone in your hand, you probably said, that's it. That's it. This is the phone of the future. We can throw everything else away. I want to invest in Apple. And once you have that conviction, you may not like the daily drama. You may not like the delivery numbers, 10,000 like this or 20,000 in that direction. You may not like where the stock price is today, because for me today, the value is between 350 and 400. But you can stomach it because you see the goal out there. Now, is that goal 2025? Is that goal 2028? Maybe even already 2024. It doesn't matter because you have that fundamental conviction. That's your company. That's the one that will make the most disruptive change ever. And it will end paying it, right? And so I'm very cautious of all these people trying to be precise how many battery power there will be in 2028 and how many whatever and all these pricing models. I just want to, it's reassuring. I know that people love when somebody has an Excel spreadsheet and it shows $5,700 then, because we all think, oh, wonderful, I have now 184, so that's 30 times what I have, and plug in their number of shares and good it is. Don't do that. Don't do that. Believe in what the company does, or ask yourself, do you believe it or not, right? Don't jump on a stock because somebody gives you a price target out there. Believe in the team, in the products, in the services they offer, in different revenue streams, and whether that product will be needed. And I just think there is no doubt about it that the Tesla products will be needed.
I agree. And what I'll just say to follow up, I'm not saying that's 1,000 is not possible in 2025. Like I said, it's just not my base case, because if I go in like that, and I don't do all these Excel stuff, I just do some very napkin math, and I do most of my investing like that. If I go in with that expectation, it doesn't serve me to do that. So what I do is I try to go a year out, a couple of years out. I say, what do I know? What could I model out in some type of earnings? And then I try to give it a fair multiple. And I try to be conservative with the multiple, right? We were talking about multiples of 100, and I kept saying, I don't want to go to 100 anymore because we're in a different market. Interest rates are up. So now I'm going down to 40. I'm giving myself error. Like for a company growing, trading at say 40 times, and then I do some earnings of next year and say 8, and I say 8 times 40. This is just very basic, but it's it helps. That's a $320 stock price. We're at 180. So I say, is that reasonable to assume that Tesla could earn $8? I say yes. Do I say, is it reasonable to assume that the market will assign it a PE of 40 next year on a trailing basis? And if I say yes, which I do, I say that's 320. Well, we're at 180. So I could say, okay, 180, 320, that's a nice return in 1 year. Do I want to own this stock? Because each day that you don't sell the stock, you're actually buying it because you're holding it. So to me, that's my simple calculation. And if all this other great stuff happens and it goes more than what I think, great. But I'm looking for what I expect on a minimum basis to say, what return am I going to get in a 1 year and a 2 year? And if I'm confident in that, I'm fine. So I just wanted to.
And I just want to add to that, PE multiples are a very good approach to it, no doubt. But you all have to understand also, PE multiple can vary completely independent from Tesla. It can vary because of the economic situation. It can vary because of competitors. It can vary because the whole climate goes down. It can vary for a lot of different reasons. So just, what I really don't like about charts and what I really don't like about these models, and I'm not saying we should not at all have models, but what I don't like about it is there are so many assumptions that go in it. Real life just sometimes, blows them away. But the fundamentals of your company, the fact that they build the best cars out there, that they have the best software out there, that all of this can be monetized in so many other ways, those don't change. You may have a problem putting a factor time on it, and you may have a problem putting a factor multiplier of PE on it, just because there's so many other factors going into it, but the fundamentals don't change. So search for companies where you are at ease with the fundamentals, and then holding through these periods becomes much easier.
Yeah, I agree. So the PA to me is just a framework, the PE, because I'm not saying that's the be all and end all, but I need some type of metric to value something. If I just say, oh, it's a great company and it's going to go up, I need some type of framework, because if Tesla's trading 150 times, which is done in the past, but we're going into an interest rate environment where the Fed's going to go nuts, in my mind, I don't know for sure, but I'm thinking, is this going to hold up? Is the market still going to value this company, even though they're at this level, when we're about to now take the free liquidity away and the free money away? And so that's how I use it. Now, the fundamentals is everything, because what I could say is Tesla's earnings continue to grow. So I know they're a growing company, right? So I can say, well, what will the market pay for the earnings? That's why a company that doesn't have earnings, I can't use a PE, because I could say, well, this thing could go to nothing because there's nothing to value it on. Like something like a tattooed chef, right? And I'm just saying that for retail, they might be familiar with it. That was like a $20-something stock a year ago, a year and a half ago. And it was a big thing on YouTube and people were all in it. But the company has literally deteriorated. Their revenue is now dried up. The growth is gone. Their margins are terrible. The cash that they had is now to nothing. And now we have $1 stock. So literally you've lost 90+% because there's no earnings. When you don't have a company that has any earnings, there's nothing to hold it. So as much pain as we had in Tesla, the reason it won't call, and anything's possible, but the reason something like an Apple or a Google or a Tesla doesn't collapse is because there's cash flow behind it. When you don't have a company that's actually creating any cash flow, there's no buffer. It's almost like a cryptocurrency. What's the actual value of a crypto? It's nothing. It's what you think the next guy will pay for it. So same thing with almost like a stock. It's a little bit different, but it's essentially there's nothing. There's no cash flow behind the company. Go ahead, Doug.
I completely agree, and I just want to add the other story, because I saw somebody. So fair enough, Tesla is growing at 40+%. Why is it not worth more? First of all, Tesla is in an environment of thousands of other stocks. All traders, all hedge fund managers, ETF managers, mutual funds, institutional investors have a discounted cash flow model. The discounted cash flow model has one input, which is the rate, the rate of interest rates. If you come from a 0 or 1% interest rate and you move up to a 5% interest rate, meaning that's the alternative. What can you do with the money? You can put it on a 5% bond, or in the old times at a 1% bond. So how much more do you need to get out of Tesla to make it an attractive risk investment? Because obviously any stock is more risky than a treasury bond. Just by simply doing this, by plugging this 5% in, the whole model projects a lower price, even though you are at a 40% growth rate. But then again, you're not alone. You're in a consumer goods sector, or you're in a automobile sector, and so it also depends on what's happening to the other ones. That's actually an interesting point I thought this morning. I do all these ETF analysis, and in RQ they have a couple. Oh, sorry, my camera. I don't know what it's doing. Is it coming back? That's my nose. Here, yeah. In RQ they have 4 other EV makers, including GM, and we're always making fun of GM. Actually, GM is their best EV stock in that fund, right? And I mean, who would have thought that GM would outperform Tesla, would outperform the Chinese EV makers and whatever? But there you go. Yeah. So it's not, the market has a lot of other actors, a lot of other influences, and it's not us and it's not Tesla's fundamentals that are making the stock price, right? But if you are at ease, with the fundamentals, you can weather this.
Yeah. Okay. And real quick, the 3.5% 10-year, that's not like we were talking about earlier. That's not extraordinarily high. Like historically, a 3.5% 10-year bond is not, terrible for stocks. Stocks could do very well in that environment. So I just wanted to put that out.
Let's get to this topic, which I think we did tease up, so we should do it. Which is, some people, the bears, this is what they're thinking about, and not that Raphael's a bear at all. He's just explaining what some people are saying. So some people are saying that 2023 is going to be hell, right? You got the Fed fighting the demand, which is the Fed still continue to raise rates or being hawkish. Global recession, people think that that's coming, and they'll be warning about it. BYD's eating Tesla's lunch in China because they're backed by the Chinese government, so competition. Price cuts and the rumors about production cuts, and Elon begging the Fed to cut rate hikes. Some people are thinking that that's signals and signs that there's softening in demand.
I mean, there are a couple of words here that are just wrong. Elon didn't beg the Fed, but Elon told the Fed, cut it. Cut this extreme, raises by 75 points. You're going too quick. You're strangling the whole thing. That's completely different than Elon begging the Fed, right? It's just, let's put that neutral. Rumor about production cuts. They were killed 2 hours too late. I was screaming about it yesterday all morning. I'm not going to scream about it anymore because I lost my voice already. But this could be just so easily addressed, because if Tesla had an official spokesperson saying straight away when this comes out, this is false and the story's out. If Elon is awake and wants to tweet false, that works, but he's not just all the time focused on this. Then BYD eating Tesla's lunch. No, it's not. BYD has much lower profit margins and is in a completely smaller, cheaper segment and is currently raising prices. So BYD is actually for a much worse product, coming closer to Tesla's prices, and is not eating their lunch. Yes, they're backed by the Chinese government. So is Tesla, by the way. I mean, Tesla wouldn't be there if the Chinese government wouldn't help them. So I appreciate Raphael a lot, and I'm actually exchanging with him from time to time. But this one is really overstretching all the biases. That's not how bad it is. But is it at the moment choppy? Of course it is choppy. Now, I said earlier, I don't think the Fed is going to go and tighten much longer. I do agree we'll have 50 basis points here, except if we have a CPI that puts a contradiction on that one. So there is a big stress now on watching the CPI, no doubt. And this could go on another 2-3 months until people got comfortable with the situation that if it deteriorates further, they may go up even another 25 basis points, or they may just pause, and people get used to it, right? I mean, I think that, again, I want to say that watch housing, new constructions, transactions, mortgage rate, how many mortgage rate. I said it 2 weeks ago, I say it again. This is for me much more important than all the rest. And it's so slow to get into the housing market. Once it is catching up with the housing market, I think we're in safe waters.
So I'll say a couple of things. My biggest worry with Tesla was always China. It looks like this zero COVID thing, they're waking up and finally saying,
good news,
we can't do this, right? We're seeing more anecdotal information that the government is going to ease up for. Maybe they're losing because Apple's pulling out, and maybe China's just saying we can't have this. This is going to kill our economy. And we just got up to, we were about to go to the US, and now everything's coming back down. So I think they're learning that lesson, and the people standing up is actually doing something this time. So that's a big risk for me, and that's kind of be pushed to the side. So as long as they could do cars, I'm okay. So the second thing is, and we see this all the time with these Reuters reports, they have no clue. We all know this is Tesla bulls, but the market for some reason wants to freak out 6-7% every time I remember I was at my computer and we got this headline from this like nothing. It was like, I've never even heard of this thing. And I'm like, my chart went like this. I was about to buy something and I'm like, what just happened? And I see some report, Tesla demand a problem. And it was from this like nothing. It was like a journalist I never even heard of, an outfit I never heard. And it literally knocked the stock down like 6% on some crazy headline that was proved to be nothing. I don't know why Tesla reacts to these headlines like no other stock. It acts like it's a penny stock. I don't get this. This is a S&P 500 company, one of the top 10 biggest companies in the world, and it moves on news of a headline from anything, anywhere.
I can tell you.
Tell me why, because I don't get it.
I can tell you because Tesla is never responding to them. So there's one news out there, and they don't want to. As long as there's no rebuttal officially, they just don't take it into account.
but I agree with you, Alexander. But you would think the market participants, after years and years of this, would say, "I don't care
Well,
about that headline. It's been proved
I
wrong a
know.
million
I can
times.
tell
Why
you.
am I going to trade down 7% on
Well,
something that's
I
not
can tell
true?"
you. I can tell you they're not learning because they don't want to learn it, and they think Elon should finally learn it and put a PR person in there, or at least
Okay.
a spokesperson.
Battle of wills.
So
Battle
a
of
couple
wills.
points.
I'll try.
That apparently the journalist who wrote that Reuters article had done
It's always
something
the
very
same.
similar in the past, and it was proven wrong as well. And secondly, somebody said that because of the protests in China, with Chinese New Year coming up in February, it's very unlikely that they're going to be able to shut this down as COVID at Chinese New Year. People are just going to be really, really upset if they did that. And so, and then now you're starting to hear the Chinese officials making statements that they're loosening things up and they're not going to likely do this. So
I don't want to
that
cut you
looks
off,
good.
Herbert. I got to get this off my mind. This is important. So China, in China, Tesla had a record quarter, 100,000 plus. They had a weekly number that was in line with kind of what we were expecting. Us bulls even, and we're letting the narrative. I understand PR, and we all got to. Every day, if our PR department says wrong, then it'll find. I don't know what we have to do, but the number does the analyst and the market look at the numbers? Do they see Q4 is going to be another record?
Sure.
It's anywhere going to be between 430 and 450. Do they not see? What like we're putting these goalposts up of saying, we're short 2,000. Oh my God, demand problem, and we sell the stock off. It makes no sense to me, and I would understand it in 2019, 20, but now we're in 2022. We're delivering every quarter. At some point, the data is telling you that we just did 100,000 in China. There is no demand problem. Here's what's happening. And then I'll shut up. Every quarter, we have a record quarter, except for Q2, because we know why. Q4 is going to be a record. We have the other two factories coming up, and probably next year we're going to do 2 million on the low side, which is another big gain. What part of the quarter is going to be another record? Because what we do, we set up and say, okay, Tesla had a great quarter, but then the market will just say, yeah, but they can't keep it up. Next quarter, it's going to be, oh yeah, they did a Q1, but not Q2, they did it next year, but Q3, they don't believe that Tesla can keep growing. So at some point, we have to teach the analysts that we are going to grow, and that the demand for electric vehicles, and especially Teslas, is there. So when management says next year, maybe they shouldn't say 50%. Maybe they should go lower to say, hey, we're going to grow 40%. Because if we're punished by saying 50%, we only grow 45 or 46 because we had a lockdown in Q2, and now we're doing the delivery wave. We're trying to change it up because we're in a position where we can do that, and we don't have to meet Wall Street estimates every so often. Then maybe we do that. But this is ridiculous. We're playing a game we can't win, because all they have to do is keep moving the goalposts and say, well, we want you to do 2.5 million, not 2 million. So as we keep beating all these expectations, they just keep saying, well, not good enough, and we need you to do more. So I'll shut up. I'd love to hear Alexander.
Wait. Tesla had a huge PE factor because
not no more.
But listen, HAD, past tense, right? Much higher than probably deserved then, but because there was all this anticipation of future growth in it. So somehow we had an advance on the Christmas dinner, right? The second thing is that Elon, in his earnings call after Q3, pushed and oversold it, right? It was beautiful landscape, anything is wonderful, and we're going to deliver. And then he sold. Insider trading hurts confidence of market participants, not us retailers. It hurt me, I can tell you, but it hurts people that are usually holding, right? So that was something that was especially so short after being so bullish. So you have to give this time to ease out. A couple of days ago, we had a 7% day on very little good news. So it's not that all good news is no news or bad news. if the right good news comes and it's a day where the market is up anyway, Tesla will continue to outperform. But the last 2 or 3 days have been negative, right? Just because the Fed is cuffing again and blah, 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 and whatever. And then Tesla is always straight away under pressure. So if, like you and me, Christian, you like to look at daily prices and react to them, it has an influx, but then you also are realistic enough about how sheepish Wall Street is and how they react. If you are a medium to long-term investor, just don't get stressed out with this. This is childish Wall Street behavior.
And I'm okay, but what I'm just trying to say from a valuation standpoint, I keep hearing people say like, it has to go to 100. I'm pushing against the bearish narrative. So I agree with you, Elon. That hurt, and that hurt the momentum, and that's why I got out of it when the stock was before everything 1,200, and we've been over that a million times. But now the earnings keep growing 100% year over year. So even if they grow, say, the next couple of years 60% year over year, that would give a PEG ratio of 1, which is considered very good even in this environment. So if you give the earnings and you multiply it by 60 and say you're going to do $8 next year, that's a $480 stock price. We're sitting at 180. We were as low as 166. Think of 166. Numbers matter. So if you look at 166, even though, again, remember, you can't say it's a car company. It is a company that produces products, just like anything else. When people say it's priced in, it's priced in. It's Chipotle. Guess what they're going to do? They're going to make burritos. We know they're going to make burritos in the future. Does that mean they can't go up in stock price? Because they're going to make more burritos. That's priced in. iPhones. What does Apple do? iPhones. That's priced in. They're going to do more iPhones. It doesn't matter. It's cars. If you're doing cars at great margins and you're doing 50, 60% more a year, and your revenues are going up 80% year after year, and your earnings are actually growing faster than the net revenues growing, at some point, I'm not upset. I'm just a little bit, I'm trying to just,
but the good side, good side of your,
I'm trying to explain, you know what I'm trying to get at. Like, exactly. This is not, overvalued territory stuff. No, I'm tired of hearing that.
The silver lining of all this is obviously every day we can make up something else, but most of this crap is in there now, right? The bad news has been out and rehashed and hashed again, and the upside is all open, and the downside for me is really limited. I said it before. I think 160 is the bottom if ever we get there. So being at 180, if your bottom is 160 and your upside is 1,000, come on. Do it.
So right? The biggest. Go ahead.
Yeah. You've already had your chance a couple times here. All right. So the biggest bear argument that possibly could make a huge move to Tesla is demand, right? That's basically it. Is demand falling, and is it sustained demand, and the story for Tesla is over? They're not going to get the growth. And so when you look at the bears, or people who are looking at kind of trying to predict what's going to happen in the next quarter, I just watched one of these YouTubers, and he basically said, I think that it's a lie that Tesla China says that that there was no 20% cut in production Model Y, but I think that's possibly a lie. And it's like, okay, but you're looking for, like, you're picking these things. At the end of the day, if if you're bearish and you really think it's going to fall for whatever reason, you'll pick anything out there and go, that's news. At the end of the day, we just have to keep looking at the weekly numbers, the monthly numbers, and whether or not it actually is true. Let's say it is true. There's a 20% cut in production. Who friggin' cares? That doesn't mean that is a sustainable demand reduction, right? What that means is that, there's a loss of incentives that is being lost in the next year.
And they don't want to build up too much inventory.
But doesn't mean that almost Chinese consumers now hit by the recession so much that they're no longer buying anymore. You got to show me more data to prove to me that that's the reason, because there's a very obvious reason what's happening. Or, look, they're pulling up their demand levers, like the 3,750. Well, it's so logical that was done because it so perfectly matches the incentive issue, right? It's like, that's not
you're 100%, Herbert. And I just want to clear this up. I am not frustrated. I've been quiet this whole call. I've been doing really good. But when it comes to valuation, I hear people, and I get in my comments, I hear this overvaluation, and it's like, if we need to take the narrative back. We need to take the narrative back, because now the narrative is we can't keep. Of course,
We're
we can
gun
keep
shy
doing
though.
it.
The bulls are
Huh?
gun shy because we've been saying positive things for every month for the last year, this year, and we've been seeing the stock fall continuously. So everybody's now a little gun shy to stand up
But
and
if we,
say, this is
but
the month
Herbert,
it's going to go up.
I'm
Herbert,
not, but yeah.
but if we do, I think consensus is, I don't Troy Tesla. If we're going to do 430, I see everybody's numbers. I don't see a number because numbers have already come out. We already know what November was. We kind of see what's happening. If 430 is like the low, that is
For
very
the quarter.
great growth. Now next year, so if we do 1314 this year, and let's say we do 2 million next year, that's growth, right? And
Exactly.
what is the earnings going to be? So what I'm saying is, are we now going to say, is the market now saying, this is what I've been trying to get, and I would love to hear Alexandra. Are we going to say that Tesla, even if they grow earnings 50, 60%, it could trade at a 30 multiple, a 20 multiple? Because that doesn't, I understand the market will do what it does, and I accept it. I've been doing stock market for a long time, and I accept it. I've been doing this a long time. I get it. But what I'm trying to understand is the market going to say, we used to value Tesla at a premium, but now we do not value Tesla at a premium? And not only do we not value it at a premium, where other companies like Cheesecake Factory and Domino's Pizza gets 40 and 50 multiples, will assign Tesla a 20 or a 25 multiple, even though they're growing the earnings at 60% a year clip. Does that make any sense? And if the market does that, we're in the wrong stock. So we think great things are going to happen. No, they're not. So this is what I'm trying to get across to you. If okay, but hold on. If the market is going to give you a valuation of 20 to 30 on the earnings, then you're going to be here for 10 years before you get this explosion.
You will actually be here. You will actually be here for another 4 weeks, not more.
No, but this is a time to know that, because
exactly.
If you're right, when the market is, that the market is evaluating wrong, you have to pause, evaluate, but that's where you make the money, is when you think something different than everyone else.
I agree with you. Exactly. I'm just playing. I'm playing
I know.
Devil advocate.
You are, and let me explain why this is the case today and what will happen in the very short term. The market is very, very, very momentum driven, right? Yeah. And I saw a comment by Harry Chu, and he's completely right. This is a stock on top of it that's heavily option traded, right? And the option traders are even shorter sighted than anybody else. Right. So the day to day has influences from sides that we don't watch, we don't care about, yet it has a big impact on the stock price. They think we're December 6th. If they think up till December 8th, and maybe up to Powell, and maybe up to the CPI, those are the best ones among them, right? That's it. Do you think one of them thinks about the Inflation Reduction Act and has understood what that means for Tesla? How many billions more that means? So they're not there. But in January, the press will suddenly discover this, put it into humanly understandable phrases. I mean, cut it down for the monkeys, that's what I'm saying. And then they will understand. And then they will suddenly put that into their models. I mean, not that they have sophisticated models, but the 3-4 numbers they put up there, and then it will be reflected. So we just have to give it the time it takes. But if you have money today, you're right, Herbert. If people have money today, or if people want to take with a part of their portfolio that's currently in stock, some positions like leaps or whatever, thinking, I want to have a little bit more juice in there, and I have to, I can take those risks. Again, always ask yourself, anything other than stock, can you really, margin options, can you really lose that money? But if you want to do that, this is a perfect moment to consider longer strategies, because it is actually quietly too low. So your premiums are coming down. So you really may want to consider those things. I'm currently not yet. I have still my old leaps that are on which I have potentially lost a lot of money, so I don't want to add any. But it is certainly a moment where we can expect much better news in short weeks to come, like between January and March, between deliveries, which in my views will confirm at least 430,000 for that period. I expect excellent earnings, and then the first impacts of the IRA. I think we're actually in for many good news.
Okay, so let's wrap this up with some good news. Again, we like to show some Gary Black information. So he said that despite a 9% Tesla price drop in 2 days, the analysts, not that we care so much about these analysts, but they have not changed their fourth quarter or 2023 earnings per share estimates because of the rumors about China production cuts emerge. So they have not changed anything. So they either don't believe the rumors or they view production cuts as temporary, as we've been saying anyways. Okay, sure, let's say it's true. Why is the world crashing when it's very likely associated with subsidies expiring versus it being something to do with some sort of major thing? But, that's just another thing to think about. It's just that, it's like you said, Alexandra, people are reacting to the short term. Oh my God, this is bad news. Better jump, because they're touchy.
Yeah.
They're itchy.
Nervous, hurt.
Just think about the end of the day. Is anything big? We looked at the China-made Tesla's sold numbers in November was 100,000, and you can see how it's grown significantly.
Nearly double of last year. Double. I mean, this is crazy.
It's crazy. And it just means, again, that, the factories are coming online. This is China. Now we're hearing Berlin and Texas are also growing now, and they're starting to grow faster and faster. So in a couple of years, is there any chance? I mean, there is a small chance, but what's the likelihood that Berlin and Texas are not at a higher clip than they are now, or significantly higher, right? It's just going to happen. Now that's production. So then the question is demand and so forth. But show me a demand, some number that shows demand is going. And so, and just to wrap this up, and then you can go, Christian. But Mayor is saying that if you look at the cash flow, the free cash flow in fourth quarter, if it balloons past a 20 billion war chest, this is a company that is continuing. So you can there's a reduction in demand or not. At the end of the day, they're making sales at a very high ASPs. They're putting in cash in the board, and they're just continue to grow cash. Why does stock keep going up? Because of cash. They keep generating cash. When these companies keep generating cash every single year, because they exist and they continue to sell, the stock needs to catch up because there's cash in the bank. So there's no other 40% revenue, annual growth rate, 25% ROIC, 15% free cash flow margin business selling for 35 PE.
It is.
I agree with everything there, and you guys were great today. I'll finish up my little bit on this. The reason, and I'm not frustrated, but the reason I just want to mention this is because the community, analysts, CNBC, with this demand issue, we've been over this. The numbers are showing there's not a demand issue. Now the production cuts, 20%. Does that make any sense? So we could pretend they would just export it to Europe. They'll export it to Australia.
Right.
They'll export it to Israel.
Yes.
They'll use it for Q1, and they'll break the wave, and Q1 will be bigger. What are we talking about? What are we talking about? I'm just saying it very softly. When nonsensical, non-logical arguments, and we debated on Twitter, and CNBC debates it for hours on end about this production cut because some Reuters reporter decides to say, hey, I'm going to make up a story today, and they're going to cut, and then this will be fun. The stock will go 7%. Everybody will pull their hair out. This will be so much fun for me, and I'll go have breakfast. I don't want to do that anymore. I want that article or whatever, I guess PR, whatever, or use some logic and say, guys, does that make any sense? And I'll zip it and go ahead.
No, I'm actually much more positive. Our question today was, what should people do that are really under the water? Please hold. Reassess your portfolio. How much are you prepared to lose? With the part that you're prepared to lose, go into margin if you really want to do that. With the part you really need, make sure that's correctly invested and don't touch it. Don't, just give it some time now. We're nearly at the bottom. We may have actually seen the bottom, and then you would really regret selling here. That's the worst moment to sell. Just breathe.
So
hold it through.
It is all based on probability. And the probability that the stock will fall from 170 to 120, there is a probability. But the probability that it will rise from 170
much higher,
to whatever, 200 or whatever percentages, or even 300, there's a probability. And then you have to gauge which one do you think is more likely. And again, look at the company. If it was any other company, I'd be freaking worried and I'd be concerned and I might decide to sell. But in this company right now, there's nothing that's making me say, the story has changed. It is dominating. It got great products. It's got a great growing market. The other thing I just want to end is that, people say that the competition's coming, but I don't understand that part too. Because let's say they do. Look at the Apple iPhone. The competition did come. Samsung created their phone, and they copied them, and they won big time market share. But what happened to the old OEMs, we'll call them, right? Nokia and BlackBerry RIM, they died. Does it matter, though, that the Android came out and started competing against Apple? It didn't, because why? The market is not competing against just Samsung. It's competing against all the Nokias that were being dumped and needing to buy the new smartphone. Same thing's happening now. So anyways, when you see something like this, you get excited, you make a bet, and you invest. This is investing, guys. So thank you, everybody. Appreciate this great conversation.
Very lively discussion. Thank you.
we missed you, Xander. I'm going to come chase after you and find out why you didn't show up today.
Where are you? It's Xander in my camera, I think. That's what he's doing, messing up my camera.
All right, guys. Thanks, everybody. See you next time.
Right.
Bye-bye.